$600 billion. That is the number written into the largest bankruptcy filing in the history of the United States, stamped and dated September 15, 2008, and it happened over a single weekend when almost nobody was watching. Lehman Brothers had stood for 158 years. It had survived the Civil War, 2 world wars, the Great Depression, and a dozen market panics. It did not survive 72 hours in September 2008. This is the autopsy. Let's open the books. Lehman Brothers started as a dry goods store in Montgomery, Alabama, in 1844. Henry Lehman, a German immigrant, accepted cotton as payment from local farmers, and soon the firm was brokering cotton trades across the South. By the time of the Civil War, Lehman had moved to New York, joined the Cotton Exchange, and was edging toward becoming something larger than a commodity broker. Over the next century, the firm underwrote railroads, retail companies, and eventually technology stocks. By 2008, Lehman Brothers was one of the 4 largest investment banks in the world, with offices on 6 continents, 26,000 employees, and a balance sheet that touched almost every corner of global finance. So how does a firm that old, that large, that connected simply cease to exist on a Monday morning? The answer begins with a 3-letter word, MBS. A mortgage-backed security is a financial instrument built from home loans bundled together and sold to investors. The logic seemed simple enough that a 12-year-old can follow it. A bank lends money to 1,000 homeowners. Instead of waiting 30 years for those homeowners to pay it back, the bank sells the right to collect those payments to investors. The investors get a steady stream of cash. The bank gets its money back immediately and can lend it out again. Everyone wins in theory. The problem is what Lehman and others began doing to that formula starting in the early 2000s. They pushed into a segment of the market called subprime lending, which means loans given to borrowers with weak credit histories, unstable incomes, or no documentation of income at all. These were riskier loans, but they paid higher interest rates, and higher interest rates meant higher returns when you packaged them and sold them. Lehman did not just dabble in this market. They dove in. Between 2003 and 2006, Lehman acquired 5 mortgage lenders, including BNC Mortgage and Aurora Loan Services, giving them a direct pipeline of subprime loans they could originate, bundle, and sell. At the peak, Lehman was securitizing roughly $30 billion in mortgages per month. But there was a mechanism underneath all of this that made it far more dangerous than even the raw numbers suggest. It was called leverage. Lehman was borrowing money to buy assets. For every dollar of its own capital, it was controlling roughly $30 to $35 of assets. That ratio is called a leverage ratio, and at 30 to 1, the arithmetic becomes brutal. If the value of your assets falls by just 3%, your entire capital base is wiped out. You have nothing left. You owe more than you own. And in 2006, the American housing market began, slowly at first and then very quickly to fall. Home prices had been rising for years, and the entire subprime system was built on the assumption that they would keep rising, or at least hold steady. When prices started declining, homeowners with adjustable-rate mortgages saw their payments increase just as their home values dropped. Defaults began climbing. The mortgage-backed securities that Lehman was holding on its books began losing value. Lehman's response, documented in the Bankruptcy Examiner's report, was to use an accounting technique called Repo 105. Here is how it worked. At the end of each financial quarter, when Lehman had to report its balance sheet to investors and regulators, The firm would temporarily sell assets worth billions of dollars to overseas counterparties, treat those sales as true sales rather than loans, and move the debt off the balance sheet. Then, days after the quarter closed and the report was filed, they would buy those assets back. The examiner's report concluded that in the final quarters before bankruptcy, Lehman used Repo 105 to remove as much as $50 billion from its reported balance sheet at a time. Investors and regulators saw numbers that did not reflect the actual risk sitting inside the firm. Now the unraveling. By early 2008, the market had begun to sense that something was wrong inside Lehman. The stock price, which had traded above $86 per share in early 2007, fell through 2008 as rumors about real estate losses spread. In March 2008, Bear Stearns, another major investment bank with heavy mortgage exposure, collapsed and was sold to J.P. Morgan Chase in a rescue brokered by the Federal Reserve. Lehman's CEO, Richard Fuld, allegedly believed his firm would receive similar government support if it came to that. It would not. Through the summer of 2008, Lehman executives held discussions with potential buyers, including Korea Development Bank and Barclays. Those talks failed. By the first week of September, it was clear that Lehman could not survive without either a buyer or a government rescue. Treasury Secretary Henry Paulson and Federal Reserve officials convened an emergency meeting on the weekend of September 12th. The world's largest banks were called into a room at the Federal Reserve Bank of New York and told to find a private solution. Barclays expressed interest in acquiring Lehman, but UK regulators refused to approve a deal without a shareholder vote, and there was no time. Bank of America walked away and bought Merrill Lynch instead. On Sunday night, September 14th, with no buyer and no government backstop, Lehman Brothers filed for Chapter 11 bankruptcy protection. The filing listed $613 billion in debt. The number that hit the wire at 1:45 in the morning became the largest in the history of American bankruptcy law. What followed moved at the speed of panic. Global markets opened Monday to news that a 158-year-old institution had simply ceased to exist overnight. The Dow Jones Industrial Average fell 504 points that day. Credit markets around the world froze because no one could be sure which other firm was hiding the same exposures Lehman had hidden. The money market fund Reserve Primary Fund, which held Lehman commercial paper, broke the buck, meaning its value fell below $1 per share, something almost unheard of. Within days, the federal government stepped in with an $85 billion emergency rescue of AIG, an insurance company that had sold protection on the very mortgage securities Lehman and others had created. The global financial system was 48 hours from a complete seizure. Lehman's 26,000 employees cleared out their desks. Pension funds, university endowments, and money market investors around the world absorbed losses measured in billions. The firm's assets were eventually sold in pieces, with Barclays acquiring the North American investment banking operations and Nomura taking the Asian and European arms. The bankruptcy estate took years to wind down. Creditors recovered roughly 21 cents on the dollar. Richard Fuld was never criminally charged. He testified before Congress and allegedly denied knowing the full extent of the firm's risk. The examiner's report, 200 pages long and made public in 2010, detailed the Repo 105 maneuver and concluded there was colorable, though not certain, evidence of a legal violation. No criminal case was ever brought. So what does the autopsy tell us? It tells us that when leverage reaches 30-1, you are not running a business anymore. You are running a bet. And the bet only works until the market moves 3% in the wrong direction. It tells us that accounting rules written to reflect reality can be engineered to hide it, and that a company can look solvent on paper on a Friday and be bankrupt by Monday morning. Most of all, it tells us that size is not safety. 158 years of history did not buy Lehman Brothers a single additional hour. $600 billion simply stopped existing over a weekend, and the world spent the next decade sorting through what was left.